You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back. It is time to kick off 2025 in high style. Yes, it is time once again for the Advisor's Option. My name, of course, Mark Longo from theoptionsinsider.com. I want to say a quick thank you to all of you out there who made 2024 such a great year for the network, whether you're downloaded, streamed, subscribed, listened to any or all of the shows we did last year, engaged on social media, whatever it is you did to engage with our content. We want to thank you all out there. We literally could not do it without all of you folks out there. And there are more of you all the time. So welcome to all of our newer listeners, and a tip of the cap to all of our long-time listeners out there as well. And of course, if you want even more content in your lives, a great place to go, theoptionsinsider.com/pro. Want to welcome all the new folks who joined us on the Pro over the holiday season. We love to see so many fun folks hanging out over there. Speaking of fun folks, let's see who's joining me on the first Advisor's Option of the brand spanking new year. That is 2025. I am pleased to be joined once again by our old pal, my Advisor's Option partner in crime, none other than Mr. Matt Amberson, the founder over there at ORATS, aka Options Research and Technology Services. Mr. Matt, welcome to the Advisor's Option for the first time in 2025, sir.
The funnest of the fun folks is what I want to be. So that's well, what I'm working on.
Well, you were in a ZZ Top video, so I guess that kind of helps, right?
Inside Out the movie, Mark. Don't forget my two starring roles.
So yes, there you go. So that definitely puts you in the fun category, whether you're the funnest or not. That might be another poll we have to put out to our audience. Who is the funnest of the fun people on the network? I am going to defy the Larry David rule, Mr. Matt. He says the cutoff is the third day of the new year for Happy New Year's. But I'm going to defy that. It is January 7th. Happy New Year to you and yours, Mr. Matt. How was your New Year on the shores of New Hampshire?
Yeah, I was watching probably one of the funniest Larry David Instagram posts where he cracks me up sometimes. So I had a very nice time. Of course, it's my anniversary, along with the anniversary of one Henry Schwartz on the New Year's.
Two smart men didn't want to have to remember their anniversary. Very smart.
And one of the secrets of a good marriage is not forgetting your anniversary, and that's how I do it. And even better, as mine is 111, so I don't even have to do much math to be right there, Mark.
Always good to remember the anniversary, and it's always good to kick off a new year, listeners, by looking back in the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement. This seems like a new segment to me, but it's a few years old now. It was born of the pandemic because so much madness transpired month to month in between episodes of this show that we really were forced to spend a lot of time just saying, what the hell just happened? So it is now encapsulated in its own segment. Thus, the P&L statement was born. Mr. Matt, a lot of stuff going off. I've said before many times, the new year comes in like a lion a lot lately, especially in the last few years. Kind of doing the same thing right now. But before we get to all the current fun, Mr. Matt, last year was a wild, a tumultuous, pick your adjective, except for mild and boring. Those don't apply. But most other adjectives tend to apply for last year. And by the way, listeners, if you want a lot of end-of-year content, we've done a lot of it already on the option block. We've done it on Volatility Views. We've done it on most of our other shows, TWIFO, the Crypto Rundown. We broke down the markets in a variety of different ways on those shows, so make sure you check those out. We also have a fun listener sentiment end-of-year look-back episode coming out when the markets are closed on Thursday. So a lot of great end-of-year content coming for you. But that said, Mr. Matt, as you look back on the wild, the tumultuous year that was 2024, be it from an options perspective, from a volatility perspective, whatever resonates to you, sir, as you look back last year, what really stands out in the mad year that was 2024?
Well, I think you have to look at, from an options perspective, of the zero DTEs just dominating, and also, what I use as a benchmark for how strong the zero DTEs are is the slope, and how it's really helped the slope. As you know, I'm in the camp of zero DTEs are good for the industry, good for risk, good for the market, and for the most part, the slope held until about summer, and then it kind of bumped up. It's almost in a new paradigm since summer through the election and now into the new year. The slope is higher. What that means is the puts are higher. So, my theory before was that the market makers in the SPX were able to use the zero DTE to hedge their book. Since the paper was both ways, they were able to pretty reliably get a good source of puts, and so their normal positions of being short puts, because people are buying puts from them and they're selling calls generally, is the skew that happens with market makers. They're able to hedge that off. And in some of the duress that the market has experienced, the slope has spiked up, so they haven't been able to reliably depend on that. So their source of liquidity in the puts dries up a bit. So I think that they're now kind of refactoring at a higher but still lower level than it used to be. It used to be almost pinned at 9% every 10 deltas is how much higher the implied volatility was in the lower strikes than the higher strikes. And then it got way down to about 2%, which is pretty crazy, but only touched there a few times and averaged maybe 4%. And now it's up, in the sixes, not the nines, but the sixes. So that's I think one of the bigger stories. I don't know if you want to pause there and ask any questions, but I have one other thing to talk about too.
Now, you were very much in the vanguard of zero DTE adoption. A lot of people were skittish on them, and to be frank, many people still are. I think the jury is still out on them, but you've been very much in they are risk mitigating, not risk additive camp, especially for the market makers. I think we saw some of that borne out. We did finally see the test, Matt, right? We were all waiting for years, right? Okay, the zero DTE is here. That's fine. Are they gamma bombs? Are they not? We haven't really seen them put to the test. We did see that this year on August 5th. And Matt, we're all still here. So I guess that's one feather in their cap, sir.
Well, yeah, definitely. I mean, I think that, sure, in August, they spiked the skew, but, I think it was dampening rather than exacerbating, the zero DTEs, that is. So, I think that market makers, like I said, they have their position on, they're able to mitigate some of their shorts. Unfortunately, it still hurts a lot because, as we know, the Vega expands, and so they're going to lose a lot. So they crank up the skew after that type of a situation. But anyway, yeah, we're still here, and I think that even adds a little bit more to my argument, Mark.
Well, 0 day aside, we can spend the rest of the show just discussing the ups and downs, the pros and cons of 0 day. You have given me an idea for a good audience poll that we might do in the coming weeks, sir. So we'll check back on that in a little bit. But that said, what else stands out to you as you look back on the mad year that was 2024, sir?
Well, I think 2024 is the year that the bubble, we'll look back. I think we're going to be looking back at it like it was the year 2000, before the bubble burst. And I say that because a lot of the assets and a lot of the skew that I look at to identify that type of situation is here. And listeners will know that I look at the ORAT's component-weighted implied volatilities in the 5 delta calls. I know that's a mouthful, but divided by the 75 deltas. And that hit at high a couple times. It hit it in May, and then again it hit it in late or kind of mid December, and it's still pretty high, but it's come down since then. And what I think that shows is a lot of people just reaching for calls. We saw the last time it was this high is the meme stock craze, and now it's kind of the meme stock craze all over again. We're seeing, these types of assets, and that's what I use as a proxy for that measurement in the options market, and also Bitcoin and MSTR and that whole thing is looking pretty frothy to me as well. I don't think Bitcoin's a Ponzi scheme. But I do think MSTR, the way he's treating it, is starting to look like that. And if you've read Hijacking Bitcoin, which I recommend, you'll start to see that there's been some shenanigans with Bitcoin. Bitcoin Cash still remains pretty true to Satoshi's vision, but Bitcoin itself is kind of losing some of its, shall we say, luster that was as a kind of a dream for individuals to maintain their power and not centralized. But now with lightning networks and what's going on with Bitcoin, it's getting more centralized, and also, but I think being pumped up quite a bit. So I think we'll look back on 2024 as the air going into the balloon, Mark.
Yeah, certainly that balloon getting a little bit frothier today, listeners, as we're coming into the start of the year. We have seen a lot of green on the screen. We've seen markets rallying today. Now the market's getting a little bit spicier, as Matt alluded to, that volatility balloon getting a little bit more full. VIX cash, as we're coming into this show, again, recording early in the year, listeners, January 7th. The S&P off over 1% right now, about 1.1%, so back nearly 100 handles below the 6,000 level that it just broke through just yesterday again. And then, of course, we have most other indices off. NASDAQ off nearly 2%, and the VIX at right around 17 3/4 right now. So getting a little frothy, a little spicy. Speaking of a spicy VIX, Mr. Matt, as we speak, as we are recording right now, Mr. Matt, our official VIX 2025 poll is live right now. People love this. They play along every year. We had thousands of submissions a year ago in our 2024 contest, which we will reveal. There were some winners. You folks were eerily precise in your VIX prognostications last year. And we just made our contest for 2025 live, Mr. Matt. So I will give you a choice, Mr. Matt. You have been invoked in that contest. You are officially, legally obligated to reply with a response. You want to give us your answer now, or do you want to mull it over for the show and give us your VIX closing price for the end of 2025 at the end of the show, sir? What do you feel like?
14 2/3 is my estimate.
Right off the bat. All right, I'm going to make a note of that right now. 14, I'll put you down 1466 for precision purposes, unless you prefer I round up to 67, Mr. Matt. I'll let you make that.
I think you got to round up.
Okay,
because it could come down to that.
It very well could. It did this year. You got to be within 1/10 of a point for our margin of victory. It's a hard one, I know, but it is impressive. Some folks managed to do it this year, which is deeply impressive. All right, Mr. Matt, 1467, you are on the books officially as we keep on rolling, listeners, and continue the mad year in review as we head on into the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, listeners, welcome to the Earnings Volatility Report. Another segment, again, born of the pandemic. The show evolved quite a bit in those mad years, listeners, because both Matt and I were kind of flummoxed as to what the heck was going on with earnings vol. No one seemed to care. It was just heading to zero. Well, fast forward a few years, and that is no longer the case. If you've been listening to this show at any point during last year, you know earnings vol was off the hook, off the chain, as the kids say last year. We've been tracking this for some time. Matt and his team have been crunching the numbers for us for some time on this. We maintain a rolling 3-year, so 12 quarters average, listeners, and that average has done nothing but continue to skyrocket month after month and season after season. We got up to 113% heading into Q3, and we thought, okay, it's got to top out there. And then lo and behold, Q4 comes in and says, hold my beer, kid, and just blows the doors off yet again. Our long-term average, Matt, as we end the year and head on into a beginning of a new earnings season here in 2025, our long-term average, I mean, you've been crunching the data for us, so maybe you have a different data point in mind, but to my recollection, as long as we've been crunching this data, this is the highest I've ever seen it at 117%, which is just a mind-boggling number. So first off, do you concur with that? Is this the highest you recall seeing as well? And then B, as you look back on the mad year that was 2024 from an earnings vol perspective, what really stands out to you, sir?
Yeah, that is as high as I've seen it. And it's not crazy because we saw it the other side too. We've seen it like 83% the other way. So that indicates, and what we're talking about here is what is the average, I was going to say return to straddle owners, but that's not really fair to say because there's slippage and everything. But so let's just say what our implied move is with the actual move. So the actual move, when it's over the implied move, that's usually good for the holders of options. So that's what we're seeing at 17% over right now. So it almost looks like a 17% return for almost 1,000 number of firms over the last 12 quarters. So, and, you know, the implied earnings that we're seeing coming up, And true that it's out a ways, but it looks low again still. And so the rule of thumb that we've come up with over these years since we've been watching it is when there are large macro events happening, i.e. the COVID crash, and when there's a lot going on, that really hurts the returns that the straddle owners get. When people care about earnings and when they're looking at earnings like they are now a lot more, especially future earnings, that's when there tends to be outsized moves over the implied moves. So you would think that they'd imply their earnings a little bit higher, but it looks like it's going to be a low implied earnings move. Again, it's out of ways, so that skews the numbers. But so that's a pretty big number, pretty good return for the longs when they've had to suffer for so many years. And upcoming, it looks like they're going to continue to. If I had to guess, it looks like I'd rather be on the long side than the short side of the straddle owning for this next upcoming earnings season, Mark.
It's fascinating. When we first started crunching this data, and for a long time in the history of this network, when people would ask us this question, should I lean long or short premium heading into earnings? We always would say it's a crapshoot. The data is pretty much 50-50. You might have a blowout one way or the other, but for the most part, it's pretty much a crapshoot. We can't really say that over the last couple of years, Matt. It's been decidedly biased towards the long vol side. They've done pretty well. And you're right, it does seem like the momentum is in their favor, which is a wild thing to say out loud. I never thought I would say that, but that's the way the data is leaning. So we can only fight the trend for so long, Mr. Matt. It would be fascinating to also go back and look at all of our data points since we started crunching this, which has been longer than 3 years. It's been a number of years now. And to see what the total long-term average is, or if it settles out right around 100%, Matt, which would probably be the case. What do you think?
Yeah, because what we're looking at is just a rolling 12-quarter average. And, that's what I would tend to think, because when you said it's 17% an outlier, it is, but we've seen 17% on the other side. So I would tend to think that it probably is right around 100%. But it seems rather sticky, meaning it tends to trend, Mark.
Yeah, I had the same thought when you reminded me of the 83% we saw in the nadir of the pandemic. You're right. That probably erases our 117 right now. We're probably hanging out right around 100%, which is, again, why long-term listeners, we've said earnings season is a crapshoot, which it has been. But right now, the momentum is definitely on the long ball side. Any particular names or developments or straddles you're keeping an eye on for the first quarter, the first season of the new year, sir?
Not really. What is interesting is NVIDIA. That usually comes out later, but then you get the Bank of Americas that start off early. So currently, Bank of America implied at 3.7. They're reporting on the 16th, so in 9 days, and their average actual moves only 2.5%. Wells Fargo Corp, they're implying they're usually higher. Yeah, they're usually 4%. They're at 4.6% now. Their actual moves are only 3.2. So those are a little bit higher coming in, and those are the first ones that we're gonna hear from. Citigroup, symbol C, is 3.6 versus implied at 4.5 average. Actual is 3.1. So it seems like, at least in those bank stocks, they're a little above what their average actual moves have been. So it looks like, I don't know, Mark. It still seems a little early. People still have a week to shuffle things around, and that's when the big trading and the earnings start to go off.
Do you think, listeners, this will be another wild season? We had questions of the week about that over the course of the year. Do you think the vol trend will continue? Will we continue to see outperformance on the earnings vol front? And you folks overwhelmingly chose yes, and that was indeed the right answer. As we keep on rolling, listeners, it is time to get the buzz for the first time in 2025.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we break down some of the stories, the headlines, the breaking news that has been going on in the world of options. Maybe you missed it because you're busy talking to your clients over there. We get it. These are the times you need to be answering that phone, especially the year. The year kicks off firmly in the red, listeners. That phone's going to be ringing. But one of the stories, one of the trends we've been watching for a number of years now on this show, certainly again post-pandemic, has been what's going on the options market and the options volume front. Early on, people like myself and Matt, we both were kind of skeptical. I think some of that is just bred into us from our market maker training to be a little bit skeptical of these trends. It didn't seem like this options explosion could continue. It seemed like everyone was trapped at home in the early days of the pandemic. Trading at home became the national sport because there were no other sports. There was nothing else you could really do. Seemed like an aberration. It would go away once folks went back to the office and everything like that. Sure enough, a few years later, hasn't gone away. It has just continued to rise and just continue to explode in volume. And Matt, we finally have the official numbers for the mad year that was 2024 from our friends over there at the Options Clearing Corp. And let's start with December, because December, was it a wild month, listeners? December usually kind of a sleepy period in the market. Everyone's gone. No one's really on the trading desk trading a lot of volume. So was December sleepy? And the answer was no. It was a pretty rock'em sock'em month. Overall, December volume up 20%. That's a lot. 20% from December of 2023. We're at 916 million this time a year ago, which, again, that's a lot in and of itself. Blew the doors off that this year. 1.1 billion with a B contracts in December. Again, just to give you some frame of reference, listeners, that's 1.1 billion contracts in a single month. The entire options market, the entire options industry, not that long ago, 2017, 2018, 2019, heading into the pandemic, was putting up 4.5 billion contracts total in a year. Now we're doing 1.1 billion in what is supposed to be the sleepy time of the year. So again, that's why this has taken so many people by surprise. This just extreme amount of volume and extreme volume growth in terms of different market segments. The equity options in December, a banger. After we saw last year, overall equity options volume was kind of unched on the year. Some people thought maybe that was going to be the chink in the armor coming into 2024, that maybe all the growth was carried on the back of 0 day and the indexes. And if you strip that away, the single names are actually going to lose some volume. Well, that certainly was not the case. Up about 30% in December of this year. ETF options up 11.5%. Index options, everyone's talking 0 day. The index options up only 6.1% in December. The futures as well. The VIX futures up 11.3% in December. So a banger month. What about the year, listeners? How did the year finish up? Was it a banger year? The answer, once again, yes. Blowing the doors off an already impressive 11.1 billion contracts in 2023, coming in 10.6% above that for 2024, listeners. Almost 12.3 billion contracts total on the year. Where was that growth coming from? Again, equity options kind of leading the dance, which is interesting because in 2023, they were kind of flat. So coming roaring back to life, I think maybe some of that return of the meme stock, some of all that roaring kitty fun we saw in late Q1 into Q2 of this year, probably contributing to that. Either way, 16.1% growth in overall equity options year over year, listeners. ETF options actually kind of the laggard of the bunch this year, only 4.1% growth. They were 4.47 billion a year ago, 4.6 billion this year. Index options, everyone's all hot and bothered about 0 day, up 8.9%. They were 959 million contracts a year ago. This year, 1.04 billion index options. Again, total volume up 10.6%. And again, the futures also having a good year. Again, most of that is VIX futures, even though some other products are starting to sneak in there as well. Overall, futures volume cleared at OCC up 7.7%. So if you're looking for a little bit of VIX futures in your life, you had a good year there volume-wise as well. Mr. Matt, I'm curious your thoughts on these numbers. Any surprises, anything making you stroke your chin and say, in these numbers, sir?
Yeah, so I have an opinion on this. It has something to do with our future plans at ORAT. So there's a lot more automation out there that's making its way all the way down to retail. So, and we're seeing some firms pop up that are working with us that are doing, quite a bit of automation. And some of the numbers that they're talking about as far as volumes go are just make you shake your head. Like it's, they're just going for these small bits of edge, and they're doing a lot. And zero DTE allows them to do it many times per day, and they're able to cover slippage and commissions and fees and make a little bit and just keep doing it and keep doing it. And so that's really driving up the number of contracts traded. And like I said, it's getting all the way down to even retail people are able to do it now. And we're helping to at least, we don't auto trade here. I've always been very, very shy to do that, but we do have our partners do it. And so we do a lot of the back testing, and then there are companies that will implement rules-based strategies and actually do a pretty good job. There's some great programmers out there that, I've always shied away from. I tried to do some automated trading way back in the day, and it's just very hard to think of everything and make sure that you're doing it safely and wisely. And there's so many things in the market, but people are doing it now, and I think that has a lot to do with these numbers that we're seeing, Mark.
Yeah, I was personally encouraged by the fact that we did see such strong growth in equity options, because the single name equity options, at the end of the day, a lot of that is the bellwether for the retail demand, the retail explosion. Call it what you will. A lot of people have talked about that kind of carrying the market on their backs. And if that was starting to dry up, maybe it was a sign that that retail influx, which is the lifeblood of the market at the end of the day, that was maybe starting to dry up. So I was very much encouraged to see that was not the case this year. Did you have, listeners, on your bingo card, did you have a nearly 11% growth rate in an already explosive amount of volume? I mean, we're talking 3-4x the types of numbers we were putting up just a few years ago. I mean, this is kind of wild stuff here, listeners. Again, a lot of that on the retail, a lot of that also as a result of a lot of these big funds launching that are derivatives based. They incorporate derivatives in a wide variety of ways that were unthinkable just a few years ago. So that's driving a lot of volume over there as well. Of course, the 0 day driving more people to the dance as well. So it's a combination of factors, and all of that rolling together to a nearly 11% increase. If you are part of that number, if you are part of that increase, listeners, I tip my cap to you, because you have been carrying the options market on your back and doing a darn fine job, if I do say so myself. And speaking of you folks doing a great job, you always do a great job with your questions. We've been very busy with a lot of great topics throughout the year last year. We haven't had a chance to address as many of them as I would like here on the show. So what better way to kick off the insane year to be, that is 2025, with an office hours extravaganza. The shingle is up, listeners. Our door is open. We'll squeeze as many of you as we can onto the show. Here we go.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, Mr. Matt, we've been kind of negligent. We've been busy with other topics. There's been a lot going on in the world of options. So we've let the mailbag get kind of full. Are you ready to take on all comers, sir?
I'm ready.
All right, let's see if we can clean it out a little bit. Let's start with this question from Rudat, R-U-D-A-T. I'm going to go with Rudat. Why not? Sounds good. He or she wants to know. This one's for you, Matt. He says, does the ORATS team ever backtest strategies on the volatility ETFs like SVIX or VXX? Thanks in advance. Mr. Matt, he wants to know, are you crunching the numbers on some of the, let's say, the funkier Franken products, like, let's say, the inverse vol, like SVIX, or maybe UVIX, or a more plain vanilla product like VXX?
Yeah, I saw that question, so I went to our trusty legacy backtester. We have a backtest finder. The backtest finder is actually on Interactive Brokers. If you go to the Explore page, you'll see it there. But we have a legacy where you could do custom. And so I ran a few of these for old Rudat. For his TIA, thanks in advance, SVIX, VXX. And so here are some of the results. And he, of course, was talking about those. And I'm guessing that you want to be short the VXX. And so I ran short call spreads. I ran long put spreads, long puts in VXX. The best from a Sharp looks like the selling the call spread. So we have a pretty standard 30-day, 30 delta default that I just fired off. And then I said, well, let's look at like a more in the money or more out of the money. And so I looked at the call spread that's at the money that had the best. Let's see, that actually had the best return, but not the best Sharp. So just selling the call spreads look like the best things, but go over to ORATS and you could test these to your heart's content here. They look good, except for obviously when the market goes against you, but short call spreads weren't that painful as far as drawdowns. The SVIX, yeah, we could also do. I was assuming that he'd probably want to see the long, since the SVIX is short VIX. So I ran long call spreads, long calls, short put spreads, and SVIX. And the best one from a total return and from a Sharp was the long call spread. So you can remember it. Long call spread SVIX, short call spread VXX were the best out of a very small sample here that I just ran since I found out. So you could check those out, Mark. And yeah, thanks for the question.
Interesting. So selling the call spreads a little bit better than just straight buying the puts at the end of the day. Interesting. I wouldn't have maybe guessed that. So that's why we crunch the numbers here at the end of the day, Mr. Mass. Speaking of crunching the numbers, I have a note on this next one that you ran a back test. I don't think we've answered this before. If we have, by all means, let me know. But this question comes in here from Mentha. They want to know, if I buy calls over time in SPY, is that as draining over time as buying puts? He's obviously referring, Matt, to the fact that we pointed out many times, and various studies point out different numbers. You probably have your own number from crunching the back test, but a lot of studies seem to point to somewhere around 8% annually, if not more, depending obviously on skew and vol and everything like that. Let's call it a baseline of 8% that it would cost you to buy somewhat reasonable protection every few months and roll it in the S&P throughout the entirety of the year. Mentha wants to know if they do the same thing. So instead of just buying the underlying and buying puts, obviously synthetically they could go buy the calls instead. He wants to know, if I buy the calls over time, is that as draining?
Yeah, so I went in and did some tests. So again, our long call 30 days, 30 deltas on SPY to simulate the long call. Overall, it was about a break even since 2007. In the last few years, it looks like a break even too. Did poorly in 2022, as you might imagine. Did well in 2023, and actually broke about even in 2024. With this, with the market up, what was it, 26%? So, not the best strategy there, Mark, for the long calls in SPY. Of course, these are out of the monies. And I did run an at the money that actually did better. So the at the money did do better, since as the market goes up, you're tending to get better deltas. So it actually made money in 2024. That's actually kind of interesting. You made 5% in the at the money. You broke even in the 30 delta. So yeah, that is pretty painful, just a straight buy of long calls, especially on a drifting up market like we've seen in 2024, Mark.
Yeah, that's kind of rough. You do quote unquote the right thing, and it still doesn't work out for you in the end, Mr. Matt. But again, that gets to strike selection. It gets to the amount of premium you're paying for these calls. A lot of factor goes into that, Mr. or perhaps Mrs. Mentha. Great question, though. Good to see you're paying attention. A lot of folks liking the back test questions, Mr. Matt. Let's see. Let's keep rolling here. Let's go out. I like this handle. This might get handle of the show here. This comes from Donkey Max. Donkey Max wants to know, I've heard Mark mention on the network recently that calls are, quote, bid in the Russell 2000 right now, and how that's a pretty unprecedented event. What does that mean, and why is it so unprecedented? Again, this goes to what I was saying earlier, Matt, about how we haven't had a chance to catch up with our mailbag in a while. This question obviously came in a few episodes ago. I want to guess probably early Q4 or late Q3 when the Russell 2000 was skyrocketing north. And as he points out, those calls were quite bid, not quite as bid right now. But what we were talking about there, Donkey Max, is of course skew. And by skew, if you look at all the index skew and all the index vol we talk about here on this show and many other shows on this network, volatility views, the option block, etc., it's just comparing the relative levels of implied volatility of the 25 delta put and the 25 delta call. 99.9% of the time in all the major indexes you're going to look at out there, so the S&P, the Dow, the Qs, and throw the Russell 2000 into that mix as well, you're going to see the puts trading at a volatility premium to the calls. That's just the way these products trade. People buy puts to hedge. That bids up the vol. They also sell covered calls to collect income. That also depresses the vol to the call wing. There's a lot of moving parts as to why that skew shapes up that way. So you expect that across all the major indices, including the Russell 2000. What made the Russell 2000 exceptional into the tail end of last year was the fact that it was defying all of that logic. It was moving like a meme stock. It was shooting up multiple percent a day. And as a result, we were seeing folks getting out there and actually bidding up the level of implied volatility in these 25 delta calls. That's what I meant by bid. It was just the 25 delta calls were actually trading at a higher level of implied volatility than the 25 delta put. Again, we see that in meme stocks. We see that in single name stocks. We also see it in a variety of commodities, let's say gold or maybe some ags when things are moving to the upside. We could see the upside calls catch a bid there. We don't traditionally see that in a major index. So when it happens, and again, Russell 2000 obviously smaller than all those other indices, and that's something very much to bear in mind. It has about the market cap of one component of the S&P 500. You could trade pretty much Apple for almost the entirety, or NVIDIA for almost the entirety of the Russell 2000. So that makes it a little bit more prone to these types of aberrant setups from a skew perspective. But at the end of the day, that's what I was talking about, Donkey Max. The calls were trading at a higher level of implied volatility than the comparable puts, the 25 delta puts. And that's a very rare event in the major equity indexes. Mr. Matt, anything you want to say about the funkiness of the skew and what we witnessed over the past year out in the Russell 2000 for our creatively named friend Donkey Max, sir?
Yeah, so we saw skew that was already low going into the election get even lower and lower and lower, thinking, Trump's going to be really good for small business. And then you saw, the Russell really correct, and then, it's popped up and now the slope is about 2.5 before, it's usually about 4. But it's spent some time low. So in the index itself, the calls are bid. But as I mentioned before, what's really bid are the individual names, the weighted average of the Russell 5 delta calls are really bid. And it's come down recently after that kind of mini crash that we saw in the Russell on 12/18. But as it's coming back, it looks like, those are still bid. And again, I think that's one of the canaries in the coal mine about a bubble is that way out of the money, small cap calls are being bid, and that's what happens when the retail gets in and just starts buying calls like they're going out of style, Mark.
All right, great question. Great handle, Donkey Max. You get bonus points for that. Let's keep rolling, see how many more you could squeeze in our remaining time here on the show, listener. Let's go to this question. Medellin wants to know, handles are all over the place this week. I love it. Are there any particular conferences or seminars that you would recommend for advisors looking to incorporate more options into their practices? That's an interesting question. That would be a good question, actually, for our good buddy, Mr. Eric Cott, who was a regular on the show not too long ago. He was kind of our go-to guy, attending just about every event in the country. If there was an advisor-oriented event, chances are Mr. Cott was there. We'll have to get him back on the show so we could pick his brain about something like this. You know, there's some of the big ones that everybody probably knows about already that maybe you might want to consider. Some of the big ones, obviously the Schwab Impact Summit, pretty big for the wealth management scene. Not as huge on the options front, but Schwab does have a lot of wherewithal in the options and derivatives world now. Of course, they own OX. That's been merged into their platform. They also own TD Ameritrade and TOS. So there's a lot of options expertise over there at Schwab under that corporate umbrella. So I would have to think there are more available tracks for people who are options centric at that event than there have been in the past. So that might be one I think that would be worthy to check out. I've been to the Morningstar event. It hasn't really been very options or derivative centric. That may be starting to change as well, though. As I mentioned earlier in the show, part of the growth of the options market has been the explosion of funds that incorporate derivatives. And there's one thing Morningstar loves, it's funds that they could rate and then charge money for those ratings on. So the fact that there are more funds doing this may make them more inclined to maybe talk about this space. In the past, it hasn't really been the case. So I'd maybe put that one lower on the list, but maybe starting to percolate up if more funds continue to add and adopt options. I would definitely go to the Schwab Impact Summit for options content before I go to the Morningstar. There's a few others. I've talked with many players in the industry over the years about how there needs to be some sort of certification, certificate, continuing education. Advisors love all of that type of thing. Advisors love something they could hang on their wall to say, hey, I am certified in options. I can handle your options questions. It's a marketing tool for them at the end of the day. And we got pretty close to having something like that with folks like the SIBO were interested in, folks like OCC were interested in all of that. And then Bernie Madoff comes along and just blows out everybody. And after that, the number of firms who were willing to offer that type of certification and say, hey, I have certified said person on options, it pretty much dried up because no one wanted to take that liability risk and say, hey, you certified XYZ advisor. They just blew out a bunch of people because they had no idea what they were doing. So I think that's going to be hard to get back. I know some people are trying to work to get some type of certificate programs in place, and that would be a good thing. I think anything the advisors can do to improve their knowledge of options outside of obviously listening to a show like this and have something they could also hang on their wall to show their clients, give them a little bit of a marketing boost, say, hey, I understand these options things. I think that would be a good thing. So maybe we are inching closer to that. I'll keep my ear to the ground for you, Medellin, and see if I do hear any more. But I think that's going to be slow going, unfortunately. So I think some of the latter ones, maybe the impact one would probably be my first choice. Mr. Matt, do you have any suggestions for Mr. or Mrs. Medellin? They want to check out some advisor-oriented conferences that may have some more options info for them.
You said exactly what I was thinking, Mark. So Eric Cott used to do a great job running something in parallel at the OIC. I wish that would come back because that was a really good show that he put on. And then the Schwab conferences, I've been to those. They're pretty good. They have some vendors there and a lot of the new technology. So exactly what you said, Mark.
You know what they always say? You can always tell a genius because he thinks exactly like you, right? So there we go. Great minds here colliding and coming together on the advisor's option. We got time for maybe one or two more listeners. Let's go this one from Chi-Town Indy, one of our pro members. And he wants to know, what markets outside of the U.S. equities do the hosts watch regularly? And have they noticed any opportunities there? Well, spoiler alert, cheap plug. Chi-Town, I know you know this, but maybe some of the other listeners don't. But obviously, we've been talking a lot more international vol on volatility views of late, in particular, what's going on in the Eurozone from a V-Stocks perspective. And doing that on a regular basis has kind of opened my eyes to what's been going on more in that market and also the opportunities they're in. Obviously, there's a trade there between V-Stocks and VIX and how you think those two should be shaping up from what's going on domestically in the Eurozone, obviously a lot right now, as well as what's going on domestically here in the US from a vol perspective and how that premium should be playing out. There certainly is a trading opportunity there. We've also seen some interesting setups in V-Stocks options that we don't traditionally see as much in VIX, notably a lot of downside stuff, ratio spreads to the downside. We see a legion of ratio spreads to the upside in VIX. We don't see a ton to the downside. We saw some sizable ones that worked out pretty well in V-Stocks over this past year, which also kind of opened my eyes to some possibilities out there. So I would say the markets I'm watching outside these shores that are most relevant to us and to our listeners right now are definitely the volatility markets in and around the Eurozone. That's where I'm spending a lot of my time. Mr. Matt, are there any markets outside the U.S. equities that are catching your eye right now?
Yeah, I watch EEM, and which is just a general kind of emerging markets. EFA, EWZ, Brazil, Mexico. We watch all those. Those come up quite a bit on our scans. There's a lot of liquidity in there, so I would add those to what you said, Mark.
All right, everybody. That music means we've come to the end. Man, time flies, Mr. Matt, when you're talking year in review, but it was a wild year out there. Great questions, everybody. You folks really bring it. We didn't even clear out the mailbag again. There's more we could get to. We have to have a separate supplemental mid-month episode of the Advisor's Option just to tackle all of your questions, but keep them coming. We love to hear from all of you out there. And in the meantime, Mr. Matt, if folks want to check out what you and everyone's favorite rogue AI Otto have cooking up their sleeve, where should they go? What should they do, sir?
Yeah, come over to orats.com. I'm at Matt, M-A-T-T, at orats.com. You could reach out to me directly. We have seen, record signups, people using our stuff, loving it, great reviews. We've asked for people wish lists, like we're now in a building mode again. We were in a getting live data mode up and running, and we did that. So now we're back to building. We're going to build some more like gray box automations and scanners and signals and all the good stuff. And we connect to interactive brokers, Tradier, trade stations. So yeah, come over to orats.com, check it all out, and check these back tests out. I was able to do these on the fly for the listener questions. So those are very valuable as well.
Yeah, clearly you folks are intrigued by all things backtest. Check it out over there, orats.com, ORATS.com, the place to go to learn more. Of course, give Matt a follow on the old Twitter as well, at Option Rats. While you're on Twitter, listeners, make sure you play along in our question of the year. This is our VIX closing price question. We do it every year. It's always popular. We got literally thousands of people chiming in with their suggest. Took a while to sort through all the answers from last year. Our team wasn't loving it, but we love all the feedback you folks give. And surprisingly, there were some folks who were eerily prescient in the vol market. So if you want to join the Crystal Ball Hall of Fame, you want to win some ridiculous prizes, we got some good ones in store for you, then make sure you make your voice heard in our question of the week. It's live just this week. So if you're listening to this show now, the week it comes out, get over there to @options on Twitter and make your voice heard. Matt already sounded off 14.67. I rounded up for him. Don't want to mess with the decimal points. It all becomes important, trust me, at the end of the year. So don't carp him unless you really want to. But make sure you head on over to @options and make your voice heard. And of course, check out our friends over there at optionseducation.org. Check out what they have for financial advisors from an educational perspective. Spoiler alert, it's quite a lot. That's going to do it for us on the Advisor's Option today. Also going to do it for us on the network today. Back again tomorrow with another doubleheader of the Futures Rundown and everyone's favorite Options Bootcamp. Thursday, of course, we're off for the Memorial Day for, of course, President Carter. Friday, back again for some vol talking. We'll also reveal the winners of our 2024 VIX prediction contest. And again, it was pretty impressive. So stay tuned for that. Maybe you're one of the winners. Maybe you're one of the thousands who played last year, in which case, tune in to Vol Views this week. You'll want to see if your number is called. And then, of course, we'll see you back here in the coming weeks, another episode of The Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.